Okay, sorry. There's a comment just here from Sam again, following that up again. He says, my Apple bull puts now reached 42 trades. Say 42 trades total over the year, not just this week. Two are break even. Oh, okay. So two hit break even, 38 winners, two hit break even, two hit about that 50, 60% loss we talk about with the bull puts. And you've got 20 covered calls on Apple that only lost once. And that represents 10% of the monies there, 10% of the portfolio. Very, very good, Sam, as well. Now, Sam's taking a different approach than I typically do. And, there's nothing wrong with that because he's doing extraordinarily well. And what he's doing, of course, is playing singular stocks. And he has a list of a couple of stocks he likes to trade, and then he branches out with a smaller portion of his portfolio, as he mentioned earlier, for the day traders and the fast movers. But yeah, just doing the bull puts on this position. A couple here you can see, not during this time frame, but going back over the last 6 to 8 months, maybe more, Sam, of course. Oh, draw the chart, will you? Had some hiccups here, but in general, we've seen sort of that bullish trend with occasional hiccups there as well, which could cause problems for the bull puts and those one or two covered calls you mentioned, but overall going in the exact right trend that you want. A question comes in, of course, is why don't you just follow these stocks? This is a question that came in during a coaching session earlier this week, is why aren't you trading just your standard strategies you mentioned, Mike, against 3 or 4 stock positions? Well, the reason why is because I was kind of, personally, I was kind of trained by Ernie, and I had learned option strategies to really teach them. I learned the ins and outs of each specific strategy. And what that did is helped me over time develop this idea and concept of what Ernie does and what I do, is trying to play around not only for ourselves, but for our customers, for the ability to find search criteria in our tools that show profitable return rates over extended periods of time, not just 2 years, not just 3 years, but 9, 10, 12 years in time, in the same sense of doing, whether it's weekly, whether it's monthly, whether it's bullish or whether it's bearish in that case, because we're trying to develop a trading plan. And of course, you're developing a trading plan, I know, Sam, with your strategies you're doing on Apple and on SPY and SPX, and then you find the fast movers for your day trades as well. You're looking for maybe certain things that certain people in certain groups were looking for, certain trends, certain fundamentals and technicals as well, which caused the market to be a little bit fun, hopefully, for some of us this week. But I know some of it wasn't as fun, and sort of changed a few things potentially in the future. Long story short, so what we've done with the positions that we used, and we prefer the married puts, bull put credits, calendar spreads, we've developed criteria that match what hits our, there you go, Sam, which hits our goals over long trading horizons. So I'm not constantly doing a bull put or a bull call debit spread on one stock or 3 stocks every cycle. I'm looking for the stocks that match my criteria, probability, technicals, and fundamentals for the stock, that have shown consistent returns over different market conditions and over several years. That's how we teach the tools, and that's how we trade the tools, and we teach ourselves. We all have touchstone stocks we like to visit, and we all have stocks that we'll trade off from now and then after a 6-month or 8-month period. Sam does add that Apple is a separate account only for this type of trade, plus 300 shares in it. So if you're taking if you're taking your 300 shares of Apple that you have and lowering it by the cost basis on the 42 bull put spreads, I'm assuming that you have a very, very pleasant looking cost basis, true cost basis or effective cost per share for your Apple positions. So fantastic. All right. So that's just one of the reasons why I don't just pick 2 or 3 stocks, is because of the way that I was taught and the way that, I've developed some of these searches to show for you guys and to show for myself as well, to use for myself as well in these given strategies that are hitting my targets, my success rate, and my profitability rate over different market periods and over time. Of course, if we're in a major bearish market like we've saw in February, and we saw during sort of 2018 from October into the end of December of 2018, yeah, I'm not trading bull put credit spreads when the market's bearish. I'm not trading calendar call spreads. We'll sort of shift into different strategies and evaluate more protection for the portfolio in those scenarios, following, of course, the guidelines and the indicators that pop up on the market sentiment tool in that case. These questions come in from HA, and this is really a blueprint owner's question, huh? What I mean by that is I could walk through some discussions, but you're asking specific questions about specific income methods, and I don't want to go rifling through all of the income methods because that's really a blueprint members only presentation, and some of those are already available there on RadioActive Trading for blueprint owners only. But let's take a look. Let's see, no one was probably really good today. I know there's a lot of stocks. I want to take a look at TREX for a moment. We looked at this last week, and it's I just want to kind of curious as to where it has been. Great, perfect. We're going to go back to the 6th of January, it looks like, 5th or 6th of January. Yeah, day before that. All right, we're going to go back to January for TREX, okay? I know, I keep wanting to say T-Rex. That's what happens when you still have a 3-year-old and a 7-year-old. You always have to say T-Rex in those cases. All right. But we're going to look at the, I'm sorry, I meant to look at the chain here for T-Rex. And as I mentioned, we're going to go back to beginning of January. Let's go to January 4th. All right, 82.34. And I'm going to go ahead, not knowing the prices or the risk, but we're going to buy the July 193 put on January 4th. So 82.34 is the stock price. The 90 strike put is expensive. So I'm going to stick with the 95, midpoint of 1830, okay? 95 at 1830. This is going to put me at about a 5-6% risk. Let's build this in the portfolio, take a look where our position stands and what our position is for your questions. I don't want to put it here. Let's put it in our 29th portfolio. Okay, this is my actual one, not where we started. Put it in custom spread. Sorry, I logged out of the webinar portfolio and gone to this one. Let's enter our married put, January 4th for TREX. Company owners and employees would probably be going nuts if they heard me calling it that instead of TREX, but it's quite all right. 82.34 was our price at close on January 4th. This is a simulated position, an example position. I do not have any shares, any options, or any trades in TREX right now, TREX. I decided looking at the prices, if I was looking at a search by symbol or search, I probably would have taken the 95 as well. And this was at 1860, so I think we're going to be looking at risk at about 5% or so. All right, so let's submit that. Actually, it's going to be 6 or 7. So TREX married put, max risk 5.9%, 6% on the position. And I chose this because the stock is up. And the 95 put and the stock's trading at 91.77 now. Why is I doing this? Said, question, when the stock price is above the long put strike, first, can I do it a covered call income method number 1? You could do it beforehand. Okay, it doesn't have to be above the put strike price. In this case, I'm going to likely see, wrong one. I'm going to see really good opportunities to do income method number 1. The full guidelines are discussed in the blueprint on when you would look to do it. Okay, so what I would do here is I'd go to position actions and then position analysis in this situation. And so we see here a stock at 91.77. We have an unrealized profit of 5.4% after 25 days. We know our max risk is 5.9%. I have a chance to bulletproof with income method number 1. That's shown for me here. We could sell the March 95 call for 625, which will cancel our original risk of 594. My apologies. We'll cancel the original risk of 594. We'll have a bulletproof position, but not a lot of upside. So now I see that there. I see that opportunity, and I'm going to take a look at the side-by-side comparison. What have I done here? I've generated a premium to cap the upside at 95, canceled all of the risk on the trade, And the max return if the stock's trading right at 95 at March expiration is 12.1%. Okay, now that's a good situation. That's why it's shown here to potentially bulletproof. But based on your SIGA model as a blueprint owner and your SIGA model for income method number 1 in this position, you're going to want to decide, is this right for you? In general, I'd look to go shorter term. This one looks pretty good to me. 21 days out in time, lower the risk by more than half, down to 2.9%. Still a good income method number 1. Stock doesn't have to be above the call strike price. I'm sorry, the put strike price initially. That's what's talked about in the blueprint for when and why you do income method number 1. This tool just helps you. But yes, income method number 6 is a different type of trade. It's a riskless spread trade that gives you some premium, a smaller premium than you'd get from income method number 1, just selling the call, but it leaves the upside open. That's a pretty good position to be in as well. Okay. Now, you're asking about this other discussion. So you said, can I roll out the long put to the front month at the same time I could do a bear call spreads together? Well, yeah, income method number 6, that's what we're talking about, is the bear call spread. What you're talking about is the other ways to manipulate the married put and manipulate the put option. I would only use income number 3 in a specific scenario, and that's talked about in the blueprint. It's not a good idea to use income method number 3 right now in this case. The reason why is that you're going to you end up shortening the time frame, and you'd only want to do that, and it's not shown there as one of the advantages. It's not shown there, because it doesn't match the guidelines in the blueprint. That's why it's not shown. We didn't see rules for number 3 in that situation. But 3 is only used if I can get the position to bulletproof by using 3 itself, not even considering selling the call or any other combination. But using 3 by itself to potentially bulletproof the position if available, and that expiration is before an earnings event. So doing this to the March, which still would take us through the February earnings event, didn't bulletproof the trade, so 3 is not a component I would use. I would only use it in that scenario, and if it was bulletproof, without combining it with any other income method. You can combine income methods together. I could sell the call and move the put up. I could move the put in and do another income method, 1, 6, or 5. 3 and 5 are a good tandem to work together too. And that's discussed in that chapter in the blueprint on combining income methods as well. Okay. So again, you can use 3 and 6 together, but you want to follow the rules in the blueprint for what is income method number 3. Why you would use it and when. And I sort of already discussed that here. I'd only use it in that one situation if it could bulletproof it by itself alone. If it doesn't, I'm going to consider other options heading into that potential event. Can you combine income methods on top of it? Of course. You just want to analyze which one works best for you for your SIGA model. And although the expiration that we saw, for options here, we're coming up is February 19th. The earnings on that TREX position, that example that I showed, is February 22nd. So I might sell a call for February 19th in that situation if it matched my SIGA model. But if the earnings were on February 12th, I'm not doing income method number 1, period, with any other income method with earnings coming up. Just so I like to cap the gain to the upside. I've done that in the past and things have gotten away from me. Not once because of earnings, but that was a 5. But other times it's gotten me to the DAR position recently as well, which was unrelated to earnings in that case.